Hey, everybody. It's been a very interesting year in 2023 in the stock market so far, and we're starting to see some things come back that we haven't seen in a couple of years. One of them is short squeezes. We started to see those come back in the market in full force in the recent weeks, especially with some of the most beaten down stocks in the market. So it's important for investors to take a step back and learn what they are, what they mean, what causes them, and what to do if one happens to a stock that you're owning or watching. So before we get started, please click subscribe to my channel to keep up with all of my latest content. The year is just getting started, and it's just going to get more interesting from here. And please check out the link you see on your screen for a message from our sponsor, the Motley Fool, where you can get the top 10 stocks to buy right now. So as I mentioned, we're starting to see some short squeezes in the market for the first time in a while. We saw a lot of short squeezes around in early 2021. Uh, if everyone remembers the GameStop and AMC kind of bubbles, we'll talk about those more in a minute. But it's really important for investors to know, for one, what causes short squeezes, what they are, and what to expect if one happens. So, the kind of basic kind of background information is in the short term, stocks move based on just supply and demand. Over the long term, great companies win, fundamentals take over. But over the short term, there's an old saying that the market is a voting machine. And that's true. Stocks move based on supply and demand. When there are more buyers in the market than sellers, stocks tend to go up in the short run. And excessive short selling can really add to those effects of supply and demand dynamics. If you're not familiar, short selling just involves borrowing a stock that you don't own and selling the shares in the hopes that they're going to go down and you can buy them back and return them at a lower price, profiting from the difference. If I thought a $20 stock was going to go to $10, I could short 100 shares of it and hope to profit $10 a share or $1,000 if I'm right. So a lot of major institutional investors and hedge funds and things like that short stocks in large quantities. Um, and so some stocks end up with a really high amount of what is called short interest. And what short interest is, it's the percent of the available shares to trade, also known as the float, that are sold short. So if a company has a float of 10 million shares and 3 million shares of its stock are currently sold short, we would say that it has a short interest of 30%. Now, there's no set definition of what normal short interest is. It depends on the company. It depends on what's going on in the economy right now. If there's a lot of pessimism in the economy in general, what the stock market climate is, and a bunch of other factors. Generally speaking, I usually consider double digit short interest, so anything 10% or more, to be a very high level of investor pessimism in any given stock. Now, there are cases where short interest can get much, much higher than that 10% threshold. Um, in early 2021, before we saw GameStop stock really go through the roof, its short interest was actually over 100%. So more than 100% of its shares were borrowed and sold short. That kind of created the conditions for a major short squeeze, but you don't need 100% short interest to get a short squeeze in the market. You just need a lot of investor pessimism. So, why do short squeezes happen? So, let's say that you sell 100 shares of stock short and it's trading for $20 right now. If that stock spikes to $30, you're sitting on a $10 per share or $1,000 loss. If it spikes to $40, you're sitting on a $2,000 loss. If that stock spikes from $20 all the way up to $60, you have a $4,000 loss, and so on and so on. Your losses are virtually unlimited. And when stocks start to rise really rapidly, short sellers rush to cover their positions to avoid their losses from getting out of control. Or in a lot of cases, because these are borrowed shares, their broker will make them sell or make them cover their positions, called a margin call. If they're forced to cover their positions, they have to pay whatever the current market price of the stock is. So if there aren't enough shares available to buy, short sellers can start to panic. There are only so many shares of any given stock that generally trade in a given day. Desperate buying can push these prices very, very high, very, very fast. Sometimes in the past year or so, especially, we've seen stocks get irrationally cheap in a lot of cases. Short squeezes can make stocks get irrationally high. So Here's kind of the basic recipe for a short squeeze, and it happens in 6 steps, let's say. So, step number one, a stock has been heavily shorted due to market pessimism. Maybe the company's losing market share. Maybe it's just an industry that's struggling in the current economy. Maybe it's a stock that's really interest rate sensitive and rates have been rising. Whatever the reason, a stock is heavily shorted due to pessimism in the market. Step two, some event happens that creates optimism. Maybe a great earnings report. Maybe the Fed cuts interest rates. Maybe just an analyst puts out a bullish note on a stock. Whatever it is, some event happens that causes a lot of optimism in the market. Optimism means that investors start to buy shares. So shares rise on that optimism, and short sellers start to suffer losses. That's step three. Step four is losses lead to short sellers having to cover either through margin calls or just to limit their own losses. Then the price goes even higher due to this buying, and it leads to even more margin calls by the remaining short sellers and more panic buying. And this cycle can repeat for days or weeks, as we've seen several times in the 2020 and 2021 era. Short squeezes can last for a long time. So here's I mentioned GameStop earlier. This is a chart from a roughly 2 week period in January 2021. GameStop started at just a couple dollars a share, and it rallied by 1,640% in just 2 weeks because of short squeezes. There were some notable hedge funds that had large short positions, and a group of traders got together and started to drive the price up, which led to short sellers being forced to cover. And this cycle continued for several weeks. And you see the effect there. The stock, increased to almost over 17 times its original price in just a couple weeks. So short squeezes can last a while. They can be pretty, parabolic, as you see right there. And you don't need 100% short interest to have that. There were a lot of stocks that had similar price movements in that era where their short interest was, 25%, 30%, something like that. So right now, just to kind of give you an idea of where short interest is in the market and what stocks investors are pessimistic on, there are 50 stocks in the market right now with 25% short interest or higher. Here are the 5 highest right now. See Silvergate Capital, that's a cryptocurrency focused bank that deals with a lot of crypto companies, including FTX that went bankrupt recently. Not surprising, there's a lot of pessimism right there. Carvana has almost 60% of its outstanding shares sold short. Bed Bath and Beyond is kind of one of the modern day meme stocks, if you will. 47% short interest. That stock actually jumped by 50% based on a short squeeze the day before I recorded this video. So those are some of the biggest or most heavily shorted stocks in the market right now. So last thing is, what should you do in a short squeeze if a stock that you own starts to rise rapidly because of a short squeeze? One thing, what I would strongly suggest that you don't do is trying to chase the momentum up, because we saw in that GameStop chart that it gained 1,600% in just 2 weeks. It can go the other way just as quickly when a short squeeze fizzles out. So it's really a losing battle to try to time a short squeeze. If you like a stock long term and you already own it, in the vast majority of cases, the best course of action is to do nothing. If you see a short squeeze happening and a stock doubles in a few days on no real news or anything like that, if you like the stock and you like the company long term, it's not necessarily a reason to sell, especially if you're going to get hit with a big tax bill for selling. So do nothing unless it goes to a completely unsustainable level. I own some stocks that have relatively high short interest right now. If one of them were to, just like GameStop did, increase by 17 times in price in the next couple weeks, I might be tempted to pull the trigger. But unless you see a stock go completely parabolic to an unsustainable and like a almost comical level, the general best course of action is to do nothing. It's a good time to sit back and just kind of watch market forces play out. Don't try to get caught up in fear of missing out. And it's definitely not a good time to short because people who shorted GameStop on the way up got crushed. So that's my kind of short selling 101 video or short squeeze 101 video. Please leave me any questions you might have in the comments. Remember to subscribe to my channel and hope you found that really informative. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 379% as of January 24th, 2023, and are measured against the S&P 500's returns of 113% as of January 24th, 2023.